What's up, everybody? It's Will B from the Blacksmith Podcast, back with another one, and we are on part 3, and this should be the final part on Options 101. This is for everybody in my Discord who've been asking us to break down options and help them understand what is going on in the stock market when it comes to these things. Now, in my opinion, I believe you should be trading, or I'm sorry, you should be investing. Investing versus trading is two different things. You should be investing long term for 1 to 2 years before you even start your hand at options. Why? Because you need to see the ebbs and flow of the stock market, knowing that July is the best month for the market, knowing that September is the worst, but knowing that April, December, January are also great for the stock market. These things will help you better understand um, the ebbs and flow of the market, but also it gives you a chance to watch the news on these companies that you like and what different kinds of news can do to shake up or explode or collapse a share price. So, anyway, we'll get right into it now. This is Earn Your Leisure's video on options, and it's going to be taught by this guy on the screen here, Lawrence. Super helpful guy. He actually has a channel of his own, but I found him through Earn Your Leisure. But without further ado, let's get it.
Day. So you want to keep it on day. If you keep it on day, it'll make sure that it enforces during the day. Now, if that price is at a limit order and it does not enforce at the end of the business day at 4 p.m. Eastern Standard Time, that order will cancel.
Correct.
So,
and that's not a bad thing, y'all.
It's not.
Real quick, this is part 3, right? I think I just said that, but this is part 3. I'll post part 1 in the description.
Not a bad thing.
Yeah, that's not a bad thing. I'm just letting you guys know that if you have an order
right here, all he's talking about, if you're just catching it from this, you don't remember what he was talking about from the other parts. He's talking about setting a limit order price, and he's walking you through how to actually do an option. And he said, have your ticker on day. If it doesn't execute before the stock market closes, I think he said 4 p.m., that limit order will cancel. All right.
that's pending and it's in time enforced day and it doesn't execute during market hours, options are only able to be purchased, because I know we got a lot of new people on here and they're probably going to ask the question. Options can only be purchased in between 9:30 Eastern Standard to 4 p.m. Eastern Standard Time. The only options that can be traded outside of that time is the SPY and the QQQ, which can be traded until 4:15 p.m. Eastern Standard Time. So options can only be executed from 9:30 all the way till 4 p.m. Eastern Standard Time. Now, when we take a look at the strike panel over here.
See, I'm on the West Coast, so 6:30 PST for me is when the stock market opens, and you better believe when that pre-market opens, I'm already in there every single morning. I have my oh wow, that's bad for business right there, but I guess the blacksmith's a little tired. But listen, I've been holding it back the whole time too. I've been talking. It was coming up while I was talking. Whatever, I'm human. This isn't an AI anyway. Make your AI yawn in the middle of your sentence. Anyway, 6:30 PST, that pre-market opens and it will already show you where the stocks are moving. So take advantage of that.
Turn your direction. You see we're on Apple, January 28th, 2022, which is next month's, the last week of next month's expiring contracts. We see that at the time when the screenshot was taken, Apple was at 171.89. I believe Apple closed at 175.76 today. So taking a look here, you have the strike price here in the middle.
Why is Amazon paying me $63,000 a month?
To get on here and interrupt my video.
You see calls,
some people's
puts,
kids,
and then you also see bid and ask. So on the call side and on the put side, and then the strike, that's the strike price in the middle. Now you see a highlighted blue on the left side to the top left, and you see a highlighted blue to the bottom right. So I want to talk about something Shadi said earlier today. If you guys watched his reel, he said something that was really keen, and I wanted to make sure that this was something that I touched on here tonight. Shadi said in his reel, he said a lot of people who are purchasing out the money options are losing money. So I'm going to put an end to this tonight.
Yes, sir.
Why do I say this? Because what's happening is that a lot of people are purchasing out the money options, and out the money options are very, very, very risky, especially in the short term. With leap options that have a lot of time, like January 2024, 200, you get a little leeway. But with the trading aspect, when you're buying out the money options, you're actually setting yourself up for failure. So why am I saying this? So out the money options, typically for new options traders, is like just beauty. It's like heaven. People are like, oh my gosh, it's so cheap. You mean I could buy this option for $400, $500, and I could profit from it? And what happens is that there's also a factor in of average true range. So how much does the stock move on a day-to-day basis? So my point here tonight is to really make sure that people understand that you want to focus on buying in the money versus out the money contracts. So these contracts highlighted.
I think I might have said this in the second video, but I focus on buying in the money calls. And the reason I do that is because they are already in the money. It's exactly what it sounds like. Their strike price has already been hit. So like SoundHound is trading at like $11 and something. But when it was at like $10, $9, $8, I was buying 50-cent calls. That strike price has already been hit already. So my earnings is going to start a lot sooner than if I picked a strike price of like $12. And that's what he's saying. A lot of people buy calls that are out of the money. So if it's trading at $10 and you're picking a strike price of 12, well, it's not hit it. It's got $2 to go until it hits its strike price. And then you have a break even price that it has to get up to in order for you to break even on it. So I'm telling you, I only focus on buying in the money calls, and I buy leaps. I don't even do short term. I buy 2-year contracts.
My fault. Yeah, go ahead.
Yep. So these contracts highlighted in the blue here on the top left here in calls, that 170 strike, 167.5, 165, 162.5.
Notice 170
what makes
strike
them
price.
in the money
Look,
calls?
bid and look at what it's trading at. It's already in the money.
Well, the current stock price at this time was 171.89. So what are you actually doing when you actually buy a 170 strike? So when you buy a 170 strike, you're essentially saying, hey, by January 28th, 2022, Apple is going to be above 170. Well, Apple already is. So Apple is considered this contract right here is considered in the money. The 170 strike is considered in the money. So it has what is called intrinsic value. Intrinsic value. Now the 172, 175, 177 are considered out the money. Apple is not higher than 172.5. No, it's not higher than 175, and it's not higher than 177.5. So what happens is that people who are buying in the money options, you set yourself up better. Why? Because some people may say, well, I'm paying more. Yes, it's better to pay more for an in the money option a lot of times than buying out the money options. Why? Because on January 28, 2022, a lot of those out the money options will be expiring worthless. And so most options expire worthless, especially out the money options. And so it's imperative that we understand that it is okay to spend more on buying in the money option contracts because it's going to give you a higher probability of actually profiting. And
correct. So I had to cut him off somewhere. But let's say in 2 years, this stock price is up at 250, right? That's almost $100. That's like $80, $79, right? 78.11. I don't know. Whatever. So it's way higher than it is right now, right? There's two ways to go about this. And let's say I bought the 170 strike price. What I could do, since that contract would be fulfilled, I could let it go to its expiration date, and I could actually purchase 100 shares at 171. Now that's a lot of money, right? So most of the money is in selling the contracts before it expires. So most people won't have that kind of money just sitting around. I mean, if you have $17,189 just sitting around, hey, feel free to exercise those options. Now, if you exercise those options and you actually buy 100 and you spend $17,189, you just bought yourself 100 shares at that strike price, right? So now what you do, how do you figure out your gains? Well, now it'd be 170, it'd be 170 per share. You pay that for it because that's each one costs 171. You can see with the bid and the ask, right? But you pay 170, so you take 170, you take what did I say, 250? Subtract 170, that's $80, and you multiply that by 100, so $8,000 worth of equity with that buy. So it just depends. Could you make $8,000 on selling the contract? What is it worth to you? I don't have that type of money to do on one option play. I have money like that tied up in options. However, I seek to sell the contracts. Now, if you're doing cheaper stocks, right? So like SoundHound AI, like over a year ago, was at like $2 a piece. Man, you could have put 20 contracts on 2-year leaps and did 50-cent calls. You could have put 20 of them and see that stock blew up like 200, 400% in a year. You could actually exercise those contracts because the amount of money you're going to make off of them versus the amount of equity, it might balance out, and it's not a whole lot of money to buy it when it's like $2 per share. But let's continue.
Also, guys, the first thing that we want to think about when we're focused on trading options is actually not making money. How do we protect ourselves on the downside? What happens is that if someone was to buy that 180 strike right here at Apple, and it's cost about $425, and Apple was to decline $5, that option contract would actually lose a lot more value than someone who has that 165 strike or that 162.5 strike.
He's absolutely right. When you buy an option, the first thing I'm thinking about when I buy in the money, this is why I buy in the money, is protecting myself against losing money. So right now, if we look at, let me show you what I'm talking about. So let me jump out of here. All right. I'm going to show you guys exactly what I'm talking about. So I'm going to go to SoundHound AI because it's still fairly cheap, right? It's trading at $13.59. All right. So what he is talking about, when you go to options, you're going to do buy, call. Let's pick the end and date 2 years from now, right? January 15, 2027. All right. So see, the cheapest you can buy is a 50-cent call. Well, it's already at $13. So yes, now if you look up here, if you did $15, look, it's only $5 per share. So that's going to be $510 for 100 shares, right? So it gets cheaper as you go up. So the tallest you can get is $37. But remember, it has 2 years to hit this. It has way less of a chance to hit $37 than it does to already hit 50 cent. It already hit 50 cent. You see +7, I have 7 50-cent contracts on it. Why do you think that is? I'm protecting myself to the max extent possible from losing money. I'm not thinking about making the most money. I'm still going to gain money when this goes up in equity from where I bought it, but I am guaranteed to not lose money on my option. That's what he's talking about. Let's continue.
So why am I saying this? Because when you're having your options in the money, you have what is called intrinsic value. Options that have intrinsic value, what? They actually have higher deltas. So delta is the amount per dollar that you make as the stock price increases. And out the money options have higher theta. So what is theta?
Take notes.
Theta is the time decay. So out the money options have a higher time decay. So for anyone that's been trading options before, and it's like, okay, I went and got a 180 strike on Apple, and Apple went up to 172, but I didn't make any money. Why is that happening? because what's happening is that the delta is the theta is outweighing the delta. So you're not making as much money when you have those out the money options. The only way for you to make a lot of money without the money options is when the stock has a drastic move upward. For example, today with Tesla. Tesla went up 70 points today. So the people who had $1,000 calls for Tesla yesterday when Tesla was at 930, they were extremely risky with that. But because Tesla actually went up and increased that much, people actually made a lot of money off of that. So what happens? People are ready to go ahead and grab these out the money options because they're cheaper.
Warning, don't believe the AI trading hype until you watch this entire video.
I need YouTube Red.
What happens with a stock like Apple, which doesn't really move very fast, but it is a consistent stock, as we put up on the sheet. Apple is a consistent stock. So what happens is that when these stocks don't move as fast, a lot of people get hurt because they're in out the money options, and the time decay is way too much.
We call that losing your shirt.
Yep.
Don't lose your shirt.
That's it.
Yep. So
that's it.
You want to focus on really buying those in the money options, especially if you're doing any short-term trading. If you're doing a more of a leap strategy, you still want to stick to buying in the money options, but you can actually go a little bit farther out.
That's right.
It is okay, but you do want to be protecting yourself, because a lot of times the out the money strategy is one of those sexy things that a lot of people want to push on people, but we don't want to do that here. We're not pushing sexiness out here. We're pushing consistency. So it's important to be consistent versus trying to be sexy and be.
Amen. Consistency. I'm still active duty, right? I told y'all I'm an active duty Navy senior chief now, but when I was on my ship, I was on the USS Tripoli for 3 years. I was coming from the gym one time, and the chaplain saw me, and he's from Mississippi, but he was on a border town for Louisiana, and his parents were from Louisiana, so he sounded like he had that like Cajun accent, right? And he's like, "Oh, Chief, what you doing? Coming from the gym, looking all swole and stuff. Like, I want some of what you taking." And I was like, he was always messing with me about being swole and stuff. So I was like, good dude, very good dude, love the guy. So he was like, I was like, "You wanna know what it is?" And his eyes got real big, like, "Oh shoot, I was playing. This dude's really taking something." So he's like, "What is it?" And he leans his ear in, and I said, "Consistency." And his eyes got big, and then he burst out laughing. I said, "Chaps, I've been working out since 2010 consistently. What do you want?" I ought to look different. You know what I mean? I was a $171 when I first started working out. And that's what he just said. They're not going for the sexy, they're going for consistency. And this is a guy you can trust right here with this kind of strategy. He's not going for the riskier investment. He's going for what is going to not lose you money every single time. So what if you only made 50% on each one of your options? Well, this guy made 400%. I've made 400% on my options calls. And you know how I've done it? I did the same thing. I bought in the money calls for 2 years on companies that were more than solid. And I hyper concentrated, and I didn't just buy one contract. Those 50-cent calls, you see it right there. Well, you saw it when I had up my portfolio. I have 7 of those in the money, and I'm never going to lose money. That stock's not going down to 50 cents. And if it did, I had so much time to jump out of that option. It'd be insane for me to end up losing money on that. That's guaranteed. I'm not going to lose money on that, right? That's what he's talking about. And I appreciate guys like him.
Cheap. Because the first thing that we had a mindset of coming in is, how can I pretty much take the smallest investment and turn it into $1 million overnight? And so out the money land is where most people go. And then out the money land you end up losing all your money. This is just the reality.
Yeah. So
sorry, before Troy starts, this is what I'm talking about, folks. If you have a gambler's mindset, the stock market is not the place for you. You need to go to Gamblers Anonymous and get yourself some help. Do not come into the stock market, a place where you should be investing your money, thus if every dollar was an employee, you're parking your employees somewhere where they have a place of employment where they can work and earn other employees. They can work for you and brand and put an exponent on your money over time, making solid investments, not risky ones, solid investments, right? And so if you have the gambler's mindset, your whole portfolio is going to be risky, risky, risky. So when I see people doing a lot of these penny stocks and doing investing in some of these companies that had good growth, but then they fell off because they either cooked their books when it was earnings times, allegedly. Well, I didn't say the name of a company. Companies do it, right? Whatever the case is, I'm like, this guy's got that gambler's mentality, and he's going to wind up losing his home before he ever gets it 10 years from now, right? He's going to wind up losing his children's and his grandchildren's inheritance. So y'all have to be careful. Stop shooting for the $1 million just because you get gassed up because you see somebody on a YouTube ad that pops up saying that it's possible. You know, it's also possible that you lose it all and be living out of your car. That's also possible. Not with me. Won't happen with me, and it won't happen with them because they're not going to lead you astray like that.
Couple things I want you to see here, right? Somebody's gonna be looking at this and they're like, yo, Troy Lawrence, what y'all bugging, man? It says it's $7, right? But we told you, and we're gonna reiterate it again, right? Each contract is worth 100 shares.
That's right.
And so our eyes are trained. I know, Lawrence, we have the same thing. Once we see that number, we're moving the decimal twice. And so that's not really $7. That's really $700. That's
right.
The bid. It's $700. I'm gonna show you why. And I think this is dope because I took this picture. I think Friday I took this picture. But if we go on to TD Ameritrade now, and I'm sure somebody will do this after they watched this whole class, that 172 strike and that 175 strike are now in the money. And so they're going to be blue when you look at it. And so that's pretty interesting. Another thing is I want you to notice the prices, right? If we look at the price, like that $700 bid, because it's so close, it's a lot cheaper. When we go out further, and I'm going to show you an example of that. When we go out further, right, to like 2024, it's going to be a lot pricier. And the reason being is that the likelihood of the stock or the asset, for this example, Apple, actually being 175 or 170 when it's already at 175 now, it's highly likely. So it's a premium on that. So like this expiration date is for next month, but we're going to show you an example of what it looks like in a few years, and you're going to notice the price difference. But I wanted you to just key in on that, right? Like this is not $7. This is $700. This is not $9.20. This is $920. So that's the ask. This is a problem too. Like,
and this is what he's talking about again. For SoundHound AI, right now it's trading at $13.59, right? So if I did a $12 call, a $12 call, or my strike price is $12, it's already $1.59 in the money. And so this is going to cost me $595 because you just slide the decimal 2 places, right? So if I did a contract, but it's for 2 years, right? But if I did this contract for $37, it's only $240. So you may say, well, I got $240. I can do this a couple of times. You could, but it has way less of a chance to hit $37 in 2 years than it does. Than it has of losing $1.59 over the course of 2 years. This stock grew 200 to 400% last year. It has and if you've seen their earnings calls and stuff, this stock has way less of a chance to lose $1.59 over the course of 2 years than it does to hit $37. So that's what he's talking about.
Like I get upset, Lawrence, you probably do too, right? Like I'll put a limit order in and then I'll look at last and we'll show people what last is. And I'll see somebody fills at 920 and I have my limit at 730. What that does is it messes up the chain for the next person trying to buy a contract. Now I have to raise my limit up because somebody who was inexperienced came and said, all right, well, I'll pay the premium. And so it kind of messes up the game a little bit. But we're giving y'all the game right now so that doesn't happen. So when we see that,
and then one thing I want to say is
I'm gonna tell you right now, never pay the ask.
Like when the option order doesn't execute, I know this happens to a lot of people, especially people that are not savvy with their platform. And that's something I really want to say is like, really learn your platform too, the execution of your platform. It is okay to paper trade on TD Ameritrade, Thinkorswim. Take some practice trades and get used to like the execution part. Because actually buying options like for the first time, I can admit myself, my first time buying options, I had anxiety. Like, was I doing it right? Did the order fill properly? These are kind of some of the questions that we kind of have from a psychological standpoint, to be honest. And so I want to make sure that people take time to understand their platforms. And if the order does not fill the first time, it is okay to go ahead and refresh that order and re-input that order.
All right, that's it. So look, folks, what did we learn? We learned a couple of things. If you got to all the way to video 3, take your notes and put them together. Well, they should be together. But when buying options, remember the biggest thing is to not lose money, right? The biggest thing is to not lose money. Remember, this is not Vegas. You're not betting it all on red. You're not doing that. You're trying to not lose money, right? So in the money calls, always better than out of the money calls. Remember, a call is a bet that the stock is going to go up. A put is a bet that the stock is going to go down, right? And the closer in your contract end date, your expiration date, the cheaper those options are going to be, because it has much less of a chance to hit it because you're doing a very short window. I don't mess with those. I don't mess with week, 2 weeks. I only do 2 years. The further out you make your expiration date, the more expensive they will be. However, the more of a chance they have to hit that target. So I want you to pay attention to these things. There's a couple more takeaways. Stop trying to be a millionaire overnight. Stop trying to be a millionaire overnight. I'm going to say it one more time. Stop trying to be a millionaire overnight. It takes money to make money. So if you only have $200, look, you can't even buy the highest strike price in 2 years' time for $200. It costs $240, right? So stop trying to be a millionaire overnight. It takes money to make money, right? You got to go out there and earn money through your 9 to 5. You earn money during the day while you're awake. You create wealth at night while you're asleep. And this is a create wealth strategy, but it's not a get rich quick scheme. Strategy and scheme, two different things. It's the other S, right? So guys, if you like this video, if you like this kind of content, I'm asking you, begging you, hit that like button and please share it with some people that it will help. If you have an IG, post it there. If you have or reference it there. If you have a TikTok, reference it there. Let people know, because I'm not charging anybody any money. I'm just doing this for the sake of people avoiding the pitfalls that I hit. Because I did some of this stuff when I started trading options. I paid the ask and not the bid, right? I didn't know. But now you know. Go forth and conquer. The forge is going cold. Blacksmith out. Have a good evening.